Good evening. Ira Epstein, and here we are with your Spider ETF stock market wrap-up. And this wrap-up is for Tuesday, the 10th of October, 2023. Well, the TV's obviously going to be full for days to come, if not weeks, of what's going on in the Middle East. And I think we all pull back and we understand what's going on. If you've taken notice, CNN is almost night and day what's going on in the Middle East. And now Fox is joining, pretty much doing the same thing. So you know it's hunkered in. We saw this going on before in Ukraine, what was going on at the beginning. And now, the crescendo, because Israel, the army, the IDF, might be invading Gaza at any point. Everybody's going to be covering it. But we're traders at the end of the day, and we can't forget that. A number of you wrote me and reminded me of that, and I do appreciate it. It didn't go in one ear and out the other. When I see children killed and all that, I can't help myself, okay? I do care, all right? But I care about everybody. I don't want that to happen. I could give a darn if it's a Hamas or an Israeli. I don't want children hurt, old people hurt, and that's just my nature, okay? I'm not the nicest guy in the world, but I care. So as I look at all this, we got to turn our attention back to us too. We have two war fronts we're now supporting as America. Israel, it's got its own money. It's doing its thing. We'll give them what they need and so on. Ukraine needs us terribly. They have to have us. You're not hearing anything. They have fallen out of the day-to-day vogue. And frankly, that's not a bad thing. I mean, you get worn out of it for a while, and then it becomes fresh again. You know what I'm saying? Winter's coming. The war's going to change there. Where are they going with everything? But now Russia's probably sitting there and going, yeah, I got the U.S. where I want them. They got two fronts. They're bleeding financially, blah, blah, blah. I hope that that's not what you think we're going to do, but we will be tested. The joke upon ourselves is what's going on in the House of Representatives, and this has to come to an end. I mean, we need a Speaker of the House. The world needs us to have a Speaker of the House. I don't think either of these gentlemen are going to have an easy go of getting the votes. That's just the reality of the situation. I don't think the Democrats will accept Mr. McCarthy. So maybe they're going to have to use the Speaker pro temp and let him do some of the day-to-day jobs to get monies done and so on. Don't be surprised if you hear talk about it. I read about that today, and I'm going, that's probably where this is going because there's so many differences. Let's see what happens. There's meetings tonight. It's going on. The caucus, as they call it, is going on right now. Will they call for any votes tomorrow? That's going to be a big issue. What will those votes be? Who knows? But you got to turn your attention to it. Then lost in all this is the Fed. Because the Fed's sitting there and it's got to be looking. Interest rates with all that's going on have fallen. Not hearing anybody talk about that, but we're back to like 4.6. We were just up near 5% in some of these rates, and we have fallen back down. All right? Is that permanent? Is it just because of the invasion? I don't know, and I don't think you know, but we will find out. Speaker upon Fed speaker that's coming out does not sound to me like they are in favor of going for further hikes if inflation stays low. Did you hear what I just said? I think they have come to the point where they accept that we could have very strong labor market and it can stay that way as long as you don't have the wage inflation. And to a person, they're cheering that they're not seeing that wage inflation any longer, but they are seeing the need for jobs and we're filling them. Then the argument is CPI, PPI. Those are right in front of us. So get ready. You got to buckle in for those numbers. If they come in strong, the Fed probably goes with the rates. If they come in medium to weaker, I think the Fed's probably going to take the high road and do nothing. And by the way, you know when the next Fed meeting is? I think it starts October 31st, ends November 1st. It's literally in front of you. Today's the 10th. So it's just weeks away. You've got all this data coming, and this is the data that the Fed's going to make its decision off of. It doesn't get to see the next jobs report. It won't see after these CPI, PPI, those to get the advantage of a meeting in November that's a little later in the month. This is right at the beginning. Pay attention. When we look at utilities, why are utilities bouncing? Well, with two war fronts, the U.S. being pulled in so many directions right now, doesn't surprise me. The old days, when you wanted to be in the market and you didn't know what to do and people wanted to be invested, they would buy utilities. Well, you did do something very important. You closed on both days, yesterday and today, literally at the highs of those days. It began with this move up right here, an outside day. If you've taken my outside day course, you'd understand that that was the end of a decline pattern. Outside days can be a continuation or the end of a pattern. That was the end of the pattern. You took out that high. And when you did, this is the stop orders, people coming out. It doesn't mean it can't go back to bearish, but you ended this break pattern. That mentality came to the end. Now what you have is a swing line here with a lower low, higher high. If the market wants to keep going up, a potential could be the 18-day average of closes, that line that I call the line in the sand. When I look at Bollinger Bands, you had stayed under them for these days. You got to the right-hand side, and then you popped. Think of a rubber band. You put your finger here, you pull on it like that, you let it go, and when it snaps back, that's what it does. Now, if you measure what that snapback is for you Fibonacci people, Fibonacci is measurements of force counter reactions to them. In other words, you get a line and where does it react? This is probably your first general area of your resistance. And the next might be about the halfway point. Wouldn't surprise me if it's there. I'm just doing this visually. I did not put my numbers on it, but when you do it your whole life, you start looking at charts, you get a pretty good feel. More important to me was this. This was the most important thing that happened to me. I looked at this chart. Let me come back again. Right here is where I want to be. This is embedding. When you lose that embedded reading and you get a close over 21, which you did, unless you're going to go back and next day and re-embed, what happens is until you go for these lower lows, the odds favor you're going to make a run for the 18-day average of closes. That's what I think the market is trying to do. Could I be wrong? Very wrong, but that's what I expect it is. I certainly don't like the short side. I think Rivian got very interesting. We have built in the refinancing. It's out of the way. And bottom pickers showed up at the 200-day average. If you don't believe me, that's fine. But you hit these major moving averages, and markets look at them in a major way. If the market goes up to them, this was unusual how it went right through it. I'm telling you that. Go on your chart. You'll see 200-day averages normally stop things. But that began the whole bull pattern. And since the market made that move over it and the pullbacks to it, it has been a big support area. If you don't see that, stop the tape, take a look at what I just said, and look at that. And I think you'll get the feel for what I'm saying. So that was a natural area for those that felt, well, I want to put some money to work in Rivian, X charts. Or a chartist that just says, I like that area, I'm just going to pick it up. There are many people that do that. You're not doing it because of loss of momentum in the market. You're oversold, but you haven't lost the downward momentum. And the resistance, if I'm right, should come in around the 100-day average. If it slices right through it, then it gets interesting because you can be back up here. But the chart pattern has not turned bullish. In gasoline fund, same thing. First challenge of the 200-day average and a Bollinger Band, you sell it. I wouldn't do that no matter what. And that's your battleground. Now, if you lose the embedded reading, then game changes. I want this market to stay down. Do you know why, right? Because any way we cut it, this is a tax on us, gasoline. And the lower it goes, the more money you have in your pocket, the more money I have in my pocket, and the more money we have for our other things in life. Also, I know the core CPI doesn't look at this, but regular CPI does, and that has come down. When we take a look at XLF, this is something I got involved in myself the other day. I thought the market was going to make a run for the 18-day average. I'm the happiest camper in the world. I don't care what it does at this point. That's all I was looking for, seeing if that could get up there. This market's not ready to turn bullish yet. It could, but right here, no. That is all that it owed, so to speak, was getting back to that after losing the embedded reading. And this was all that it owed right here. It's gone further. Could these markets start reacting back down now that many of them had embedded readings that were lost when we pull back? You've opened the door for that. You're right there opening that door, so be a bit careful. Same thing in AI. No, it was just oversold. Your embedded reading part was right here, and then when you lost it, it took a while, but it finally got back today to what it owed, the 18-day average. And for good measure, it went to the 200. Notice how that line stopped it, ice cold. I mean, you talk stopping it, it stopped it cold. The market fought a battle at it, came back, lost, came back. Now will it keep going? I don't think very far on this first move because you got the Bollinger Band there. Markets only stay over the Bollinger Band 5% of the time. All in all, this has been a reaction to a market that fell apart, and I'm talking the market as a whole, fell apart, and this is the bounce we're getting in many of these markets. Is it going to turn into something more? I personally think it will. That's why I did that report that I did on stock indices, showing you all four indices with the seasonals as to what I think. Let's see. You're in the early stage. The report before that, what I wrote, was a big down for September, not wrote what I did in the video, a churn in October, and eventual move to the upside after that. Don't know if I'll be right, but that was the roadmap that I had laid out. I can see the arguments right here. You lost your embedded reading. You've already gone to your upside. Are you seeing over and over? You had these embedded readings that are bearish. You lose them. The market should go to the red line, the closest main moving average. You tell me it didn't do that. And magically, it just stopped there. Why didn't it keep going? I don't know. In the energy sector, no, it never did embed. You've got a higher high, lower low. But what did I tell you here? One of the things you learn is when you see major moving averages bunch themselves together on top or bottom of the market, you don't want to press through that and say, oh, it doesn't matter. It's going right through. It's going to catch fire. No. There's plenty of algorithm trades that are built out there, plenty of traders that have experience, and they'll go, I don't want to play beyond that. I've been bearish. I think I'm overstaying my hand. In the gold market, you're getting a bearish crossover. Pay attention. You now have the 18-day average under the 200, and the 18 is under both. This is not a bullish setup. This is a very bearish setup. You heard me. Bearish setup staring you in the face. Look for big resistance, I think, at 174.31. You lost the embedded reading. I think you can get there, but between there and here, I'm looking for big resistance to show in the market. Everything is lined up bearish, not bullish, except momentum, which should create that short-term rally. Silver, the same thing. Wouldn't be surprised to get to the 18-day average. Copper. One of the things I was saying in my futures report was Golden Week, traders go away. They're all over China going to see family. Nobody's doing anything. But when they come back to the desks, the logical thing is, hey, if I need oil, I'm buying oil. They're not selling oil. They're buying oil. If I need any copper for anything, I'm buying copper. And you get all that. That's what I learned over many, many years. You get a bit of a surge. It doesn't have to last long. But typically, if you've been away from your desk and you're a procurer of minerals, metals, whatever, you're doing buying, not selling typically. In TLT, lost the bearish reading. I can argue that you're coming back here. Today was a day I had been bearish. 80 cents wrong, goodbye. Now I'm thinking you're going to 88.92 in the market. That's what I think is going to happen before you get to that low. Doesn't mean I'm right, but that's what I'm guessing. In the dollar index, you lost the bullish embedded reading the other day. You tell me you didn't get back to that 18-day average. Do you realize how important this is? Because often your momentum turns before price. And you could be in a market, bearish like TLT, and the market's saying to you, uh-oh. Instead of you hoping and going, you're hanging on, go, no, I lost my momentum. I'm going to pay attention to my rules. Now, does it always work? Nothing in life always works. Does it work a lot? You go back on your charts, you do your work, and you write me and you tell me what you see. I think you're going to be surprised. FXE, right into it. You lost the embedded reading. Right up to that, and that's where you're at. So you put this all together, and now we're back to real trading. All right, this gets interesting now, real interesting. Now, tools. You need tools because things I tell you, you need even more. You know what GAN is? You know who GAN was, what he did, the theory of it? A lot of people use GAN square of 9. Forget for the NASDAQ, just the GAN square of 9 because it applies left and right. Learn it. It's here in the book. The benefits of relative strength. Whether you're an MACD trader, a slow stochastic trader, whatever your methodology to measure momentum, somewhere along the line that came from relative strength. Learn the basics. From the basics, you can get more sophisticated. I love that. And there's many types of relative strength. There's regular relative strength, Williams regular RSI. There's different ones out there. Trading with the money flow index, very important. Where's the money going? There is a way to measure that. And of course, optimizing stops, very important. How can you get a game plan to try to learn that? I think it's important. Here's what's so neat. Look at the graphics that we've got, all this that's in there. It really is a great primer for you. So if you're looking to learn, maybe you're looking to refresh, this is the way to do it. How do you get it? You go to IraEpstein.com. It's one of our free offers. We have many. Move your cursor to the top. You'll see an icon. Give it a click. It'll take you right to that area. I'm Ira. You have a good evening. I'll catch you all in the morning. Take care.